Hello and welcome. This discussion is brought to you by the experts at Pro Tax Accountant. We're going to be talking about a really powerful bit of UK tax law called the General Anti-Abuse Rule, or GAAR for short. So let me ask you a question right at the start. Where do you draw the line between being clever with your tax planning and actually breaking the rules? And more importantly, what happens if you cross that line? Well, let's find out.
You know, for almost 100 years, this was the way things worked in the UK courts. Tax planning was basically seen as a game of wits. If you found a loophole in the law, good for you. You were perfectly entitled to use it. These words from Lord Tomlin pretty much gave a green light for taxpayers to be as ingenious as they wanted to be to lower their tax bill. And the taxman, well, they just had to deal with it. But then, this is where it all changed. In 2013, Parliament came in and decisively said, nope, not anymore. That old way of thinking was thrown out. They brought in a brand new, powerful rule designed to stop any arrangements that, might be technically legal, but went against the whole spirit of the law. The game of cat and mouse was officially over. So, to really get our heads around this big shift, here's how we're going to break it down. First, we'll look at why GAAR was needed in the first place and what the law actually thinks is abusive. Then we'll get practical and look at some real-world examples to draw a clear line between what's reasonable and what's not. After that, we'll dive into how the rule is actually applied, the pretty serious consequences, and, just as important, the safeguards that are in place. And finally, we'll wrap it all up with how to navigate GAAR today. Okay, first things first, why did the government feel they had to bring in such a massive sweeping rule? Well, the problem was that even though tax law is incredibly complicated and detailed, tax advisors were always one step ahead. They were creating these new, more and more artificial schemes just to get around the existing rules.
Before 2013, HMRC was kind of fighting this battle with one hand tied behind its back. They had these specific rules called TARs, that's Targeted Anti-Avoidance Rules, but using them was like playing whack-a-mole. As soon as they closed one loophole, two more would pop up somewhere else. So the government realized they needed a catch-all, something based on principle that could stop any new scheme in its tracks. They commissioned a study, and based on that, the GAAR was born, coming into law in July 2013.
So, if GAAR isn't meant to stop all tax planning, what exactly is it targeting? This is a really crucial point. GAAR isn't there to stop you from making sensible, tax-efficient choices that Parliament actually wants you to make. It's designed to catch something very, very specific.
And this right here is the absolute core of the law. GAAR targets abusive tax arrangements. Now, an arrangement is considered abusive if it's something that just cannot be seen as a reasonable course of action. It's not about whether every I is dotted and T is crossed legally. It's about whether what you're doing tramples all over the obvious intention of the tax laws. It's all about substance over form. For GAAR to even come into play, two conditions have to be met. First, the whole point of what you're doing, or at least one of the main points, has to be getting a tax advantage. Honestly, that's a pretty low bar for most tax planning. The real test, the one that matters, is the second step. The arrangement has to be abusive. And this is where we get to the famous double reasonableness test, which we'll unpack in just a moment. All right, this is where the rubber really hits the road. What is the actual difference between legitimate planning that we all do and the kind of abusive stuff that'll get you in hot water with HMRC? Let's try and draw that line. Okay, let's make this real. Let's imagine Sarah, a freelance graphic designer living in London. If Sarah decides to operate through a limited company instead of as a sole trader to manage her finances and tax bill more efficiently, that's totally reasonable tax planning. Same thing if she puts money into a pension or an ISA to get tax relief. Parliament wants her to do that. But what if Sarah was advised to get into a super complicated scheme, one that involves, say, an offshore trust and a bunch of artificial loans that have no real commercial purpose other than to make her income vanish for tax purposes? Well, that's when HMRC's alarm bells start ringing. That is a potentially abusive arrangement because it uses contrived, unnatural steps to get a result the law never intended. And here's a brilliant pro tip directly from Pro Tax Accountant. Whenever you're making financial decisions for your business, always, and I mean always, write down the business or commercial reasons behind them. If HMRC ever asked you, why did you do this transaction? Your answer needs to be about your business strategy, not just, to save some tax. If you can't explain the commercial logic, that is a huge red flag. So we know what GAAR is trying to do, but how does it actually work in practice? What's the process that HMRC has to follow?
This part is really important because there are some very specific protections for taxpayers built right into the system. This brings us to that crucial double reasonableness test I mentioned. It sets a really high bar for HMRC. They don't just have to prove that your tax plan was unreasonable. No, they have to prove that no reasonable person could possibly think that what you did was a reasonable course of action. This is a massive protection, and it gives the taxpayer the benefit of the doubt. If there's a legitimate, arguable point of view, GAAR shouldn't apply. And here is one of the most important safeguards in the entire process. HMRC can't just decide on their own to use GAAR against you. Before they can take any final action, they absolutely must refer the case to an independent group called the GAAR Advisory Panel. This panel is made up of tax experts who are completely separate from HMRC. So the process is very structured. First, HMRC spots a tax arrangement that they think might be abusive. Then they have to package up their case and send it to the GAAR Advisory Panel. The taxpayer also gets to make their arguments to the panel. The panel then looks at everything and provides its expert opinion. And only after they get that opinion back can a senior designated officer at HMRC make the final call on what to do. It's a proper process with checks and balances. So what's the bottom line? What actually happens if you're found to have used an abusive arrangement? And what are those key protections that make sure this powerful rule is used fairly? Let's look at the so what of all of this. The consequences can be pretty severe. First off, you'll obviously have to pay all the tax that you tried to avoid. But on top of that, you could be hit with a penalty of up to 60% of the tax you tried to save. That's a huge financial hit, and it's designed to be a very strong deterrent. Now, stay with me. The next point might surprise you in a good way. Despite those tough penalties, the system has multiple safeguards to protect you from unfair challenges. And this is crucial. The burden of proof is on HMRC. They have to prove your arrangement is abusive. You don't have to prove that it isn't. We've already talked about the high bar of the double reasonableness test and the independent panel. On top of that, any adjustment HMRC makes has to be just and reasonable, and they have to make sure you don't end up being taxed twice on the same money as a result. Okay, here's another fantastic, practical tip from Pro Tax Accountant. If you've done something and you're genuinely not sure if it can be challenged, you can be upfront about it. On your tax return, there's a white space section where you can explain the arrangement and tell HMRC you're uncertain about the tax treatment. This shows you're acting in good faith, and it can dramatically reduce your risk of getting hit with penalties, even if HMRC later decides the arrangement was abusive. All right, let's pull all of this together. We've looked at what GAAR is, how it works, and the risks. So the big question is, how should you approach your tax planning now, in this post-GAAR world? Well, it's really helpful to remember that GAAR doesn't get rid of the old rules, it works alongside them. The TARs are still the first line of defense against known avoidance schemes. Think of GAAR as the ultimate backstop. It's the flexible, principle-based safety net that's designed to catch any new, crazy, or contrived scheme that the more specific rules might miss. You really have to think about both. And this really is the final, crucial question you need to be asking yourself. In today's world of increased transparency and powerful rules like GAAR, is your tax planning built on solid commercial foundations? Could you confidently stand in front of HMRC and explain the business logic behind what you've done? Because, really, that's the standard you have to meet now. Look, navigating this line between what's okay and what's not can be incredibly tricky. If you have any doubts at all, or you need expert guidance on your tax affairs, the best thing to do is always to speak with a professional. The team at Pro Tax Accountant specializes in this area, and they can give you the clarity and peace of mind you need. You can reach them directly on WhatsApp or by phone at 079-8568-9912, or just drop them an email at info@protaxaccountant.co.uk. I really hope this has helped to demystify the general anti-abuse rule for you. For more clear and simple discussions on complex tax topics just like this one, make sure you subscribe to the Pro Tax Accountant YouTube channel. Thanks so much for watching.